Hello, my YouTube friends. How would you like to make $4,000 a month in your sleep just using dividends? Well, today I'm going to go over a portfolio that does exactly that. So stick around and we'll get right into it. Well, good morning. My name is Adam Kahn, and this is Investing with Adam K. I hope you're all doing well. Today, we're going to talk about a dividend portfolio and how you can make $4,000 a month just investing in dividends. So you can just go to sleep, money comes in every month or every quarter. Pretty simple to do, just takes a little research. Now, keep in mind, this is not investment advice. I suggest you reach out to a financial planner or somebody else for your own financial decisions. This is just what works for me, and I don't really suggest it for you. When I think about investing, dividend investing to me is really a nice way to be able to get some income coming in without worrying too much. I've looked at all sorts of different things, whether it's investing in real estate or alternative things or whatever it is that you find that you see value in. Now, obviously, everybody wants to see their money do the best they can. What I enjoy about dividends is you really don't have to do much and you can make money in your sleep, so to speak. The company does everything and they just send you a check out of the profits of the earnings that they make. There are also tons of companies out there that pay dividends, which is why I say you really need to seek financial advice from an advisor or somebody who helps fit your particular position because you have to match what fits your financial spot in life. Maybe you're better off with ones that pay lower yields or higher yields, or ones that don't even pay a dividend, depending on what fits best for where you are in terms of your age, your income, how much savings you have, and everything else. Part of why I say you shouldn't necessarily follow my direction on this is the stocks that I pick are having high yields because it's specific to a dividend account to try to drive yield to help pay bills. I separate it from other things, and these may not be the best companies in some ways, and maybe they struggle. You have to keep in mind, in order to pay a dividend, it's not just free money, and the companies actually have to earn enough to be able to pay those dividends. So if a company is offering a 15% dividend, or 15% yield, so to speak, well, they have to be generating enough income to be able to make those payments. So the higher the yield, a lot of times the higher the risk of the company. So you kind of have to do your research, understand what you're investing in, and really know that they're able to continue to pay those dividends. Sometimes, depending on your situation, you may be better off getting a stock that pays a lower dividend but is growing at a better rate and maybe increasing their dividends at a higher pace than something that's paying out most of their income. So it really, that's why I say it really depends on your age, your position, and everything else for what fits you. For me, at my age and where I am, like I said, these are pretty high yielding stocks for the most part. I actually am generating like almost 9.3% yield in total based on the amount that I have invested. And I'll go through each stock and tell you why I picked them and what I like about them and where I am on them and my thought process. So you can decide what you think on them. So I'm going to go through these stocks in alphabetical order, mainly because that's how they show up in the account more than anything else. Has nothing to do with which ones I like or whatever. And as I said, I'll kind of explain my thought process in most of them. So the first one on the list is Archer Daniels Midland. I currently have 300 shares. It pays $150 a quarter on those shares, so $600 a year. Now, what I like about Archer Daniels Midland is that they recently had a bit of an issue where their CFO, I think it was their CFO, might have been giving some bad information on the earnings, caused the stock to drop a lot. I think they're a great company. I like really good companies when they have bad news, and I felt like the value had gotten pretty low that I wanted to pick some up. Now, to be perfectly honest, it's actually a company that I think is a really good one that I wouldn't mind owning. When I say, like, don't follow me, to be fair, this is one I really like. I think it's a great investment. And I thought it was really well valued. In terms of the dividend account, it only pays a 3.5% yield, which is pretty low for what I'm hoping to get out of this account. But I still saw it as a great company. It does pay a dividend. It's one I wanted to own. I'm hoping that I have growth potential. And at least so far, it's up a little bit from where I bought it. But, my hope is that that scandal over time, people forget about it. The stock fell from, I think, around $90 a share down to $52 at the low, I think, somewhere around there. I'm not looking at the chart, but that's why I think it's a great investment. It's not particularly for the dividend yield. It really is because I think it's a good company. Next on my list is a company that the ticker symbol and the name are the same. It is AGNC. They are a residential mortgage REIT company, pays a much higher dividend, and that kind of goes to my point of sometimes you get a little attracted to yield. They're paying like a 15% dividend. I don't know how realistic that they'll be able to pay that and keep the valuation of the stock the same. I'm over attracted to the yield in it, which is why I say it may not be the best investment for you. The funny thing is I was just kind of playing around on the computer, looking at high yield companies. We were in Washington, D.C. on vacation. They're out of Washington, D.C., so I kind of looked at it a bit and thought, I'll put some money in it. It pays a nice big dividend. Now I'm getting $240 a month from that dividend. So as long as they're able to continue to pay that dividend, it's a nice payment, and it wasn't a huge investment where I'm super concerned that if they have trouble or the stock goes lower, that's an issue. It's not something I really wanted to put a really large investment in. It's also not a company I know a ton about, but I thought I'd get the higher yield, and if it helped push things up and bump up the portfolio in terms of the monthly payments and dividends and what we could use for paying for some bills, that'd be great. Now, there is always the risk that a company like that has to cut their dividends. So that is a risk you take, and you have to be careful of that or be prepared for that, which is where my brain is. So the next company on my list that I'm using to try to get $4,000 a month for is Best Buy. Now they pay quarterly. I'm just averaging out when I do the math over a year and divide it by 12. So Best Buy, what I like about them is they're paying around a 5% dividend, maybe a little bit more right now. Now, I'm not sure I see a ton of room for the company to grow. I was able to pick it up at a decent price. They've been out of favor. I think retail in general, with the economy slowing down, has been a little bit nervous. They actually have earnings coming out somewhat soon. I think it's the end of the month. So it's very possible the stock could go down a lot or up a lot. When earnings reports come out, sometimes, as you guys have seen, the stocks can have really big moves. Now, I'm currently getting $470 a quarter from Best Buy. I'm thrilled with the return. To be honest, even if the company doesn't have a lot of growth, I'm okay getting that dividend and not seeing the stock perform as well. I kind of bought it when I was looking at Target because Target was in the news, and all of retail was getting hit over that. Um, I guess we'll see how Best Buy does over time. It's not one that I think is like the greatest company out there, and you guys know from my other videos, I really would rather try to invest in general in the companies I just think are the greatest companies. But again, this is kind of a dividend play, and I just want it for income coming in to help pay bills, and it's able to do that. It's also when I look at Best Buy's dividend and what they pay versus how much they're making a year, seems like they have plenty of room to continue to pay that dividend. Now, if they decide they need to invest in the company more, of course, they could cut that to try to grow the brand or build more stores or whatever it is they decide to do. But at least based off of the last 4 quarters' earnings, they're making close to $6 a share, and they're paying out less than $4 in the dividend, which tells me they have the room to be able to do that. Of course, those numbers can always change, which is why I say you need to do your own research and kind of look into things and see what you think. But my guess is Best Buy continues to chug along and can pay that dividend. The next stock I have on the list is Devon Energy, which I have a very small position and it only pays $35 a quarter. But I like Devon Energy. I actually like the energy space because I think overall it's generally out of favor and maybe a little bit undervalued. With interest rates being pretty high, energy sectors are usually about dividends. I find that the whole sector is a little bit out of favor. Now, if interest rates start going down, which is kind of what I think is going to happen, but that's just my opinion, that you'll see the energy plays get more in favor again because of the dividend. So, just so everybody understands, if you own a company that's paying a dividend and interest rates go up and you can get a better dividend from treasuries without taking on the risk of the company, well, the price of the company could go down in value, offsetting that to give a higher yield to offset that risk of I can invest in a treasury that gives me 5% with, as close to no risk as possible versus owning a company that has risk that now you should get paid better than the no risk investment. All investments and all payouts are generally a determination of risk, and the higher the risk, the better the pay. But keep in mind, that means it's higher risk. So you have to weigh that all out. I like the energy sector. I like Devon Energy. It's actually one I think I should probably put more money in. At one point I did, but I kind of moved it into other things to get the higher yields because I wanted that for the income. So one of the stocks that I moved some of that into is Enbridge, ENB, which is also in the energy sector. Now I'm getting $535 a quarter from Enbridge. It's paying, I think, closer to 7.5% in its yield, and also in the energy sector, which I think is out of favor. So my hope is maybe you see the price increase over time as too. Now I don't expect these things to really increase in price dramatically, but if interest rates come down like I'm thinking they will, similarly, the price of the stocks may go back up. Where if you buy them in the future when interest rates are lower, you're probably getting a lower yield just because that makes sense in terms of one's risk. So, anyway, Enbridge is a Canadian energy company. I think they're really good at what they do. They pay a nice dividend. I don't really see them struggling or not making enough money to be paying it. Again, do your own research to make sure you're comfortable with it as well. I also have Altria Group, ticker symbol MO is one of the ones I have in here. Again, I have a rather small position. It's paying $294 per quarter. I like Altria Group. I think while we have so many things going on, they're out of the spotlight of things that are potentially having a lawsuit because, they sell cigarettes and people don't like it. And from time to time, they have some bad news press. They often get a lawsuit because it does cause cancer. And, while people are well aware of that, it seems to ebb and flow through these phases where they get in trouble for that. Now, I don't advise people to smoke, but a lot of people do. They're in what people call a sin sector. So you have the risk of maybe the government stepping in and causing problems and whatever else. But they pay a nice big dividend. It's close to 10% in yield. And it's a pretty safe dividend in terms of their ability to pay it. They've been around a long time. They're pretty consistent. I also don't expect the stock price to go up a whole ton over time. I just expect them to be able to make enough money to pay that dividend and potentially grow that dividend over time. So again, another one that I think is really nice for being able to pay bills and help sustain life. Well, sustain life as an investor, not for the users of the product. Forgive me, I kind of realized that as I hit pause on the video. So the next stock I'm using to try to get the $4,000 a month in return is one that I really advise not buying as much as I did. It's just that in my opinion, when I see opportunities from time to time, I will really make a much bigger bet. Um, I try to wait, and if I see something that's a great company that I feel like it's on sale, I might dive in potentially more than I should. I did similar on Meta, and the timing was really lucky. And at least for now, the timing has been lucky on this, and it's Nextera Energy Partners. Now, my quarterly payout on Nextera Energy Partners is a little over $5,000 at $5,382 a quarter. The reason for that is when I saw the opportunity and the stock fell down to 24, $23 a share, and I saw the news associated with it, I really bit off a big bite. I'm hoping that the news is accurate. I get more comfortable as I see the stock drift higher. but that doesn't mean that it's any safer than it was. And what happened with NextEra Energy Partners, and if you're not familiar with who they are, they're kind of like a sister company to NextEra Energy. They're the renewable energy source where they do solar and wind. They used to do solar, wind, and gas, but they sold the gas pipelines to Kinder Morgan to free up some money to pay down some of their debt. I'm guessing with the higher interest rates, the rate at which they were expecting to raise the dividend was lowered. And that caused the stock to pretty much fall in half from $50 a share to about 25 or $24 a share. That was a pretty dramatic fall. And the news was that they expected to not be able to raise the dividend as quickly as they did before. They originally thought they were going to be able to raise the dividend somewhere between, I want to say it was 15 to 18% per year, and they lowered that estimate to 5 to 8% per year. Well, when the stock price fell, and I was looking at it and saw at that time it was getting a yield of around 15%, and saying that they're going to continue to be able to raise that dividend at a pace of 5% to 8% per year, that's incredible return to me. Now, I was fortunate enough I didn't own it at a higher price, so I saw it when it fell today. But even where it closed on Friday, it's still paying a 12% yield from what I saw. If they're able to raise a dividend from 12% at a pace of 5% to 8% per year, again, that's still great return. So I even think that it has room for the price to continue higher. I made a rather large bet. I don't suggest other people make that type of bet. It's why I say you guys need to do your own research for what works for you. But I've transformed, I used to be a commodities trader on the floor of the exchange. And since I've left the floor, instead of putting a little in one thing and a little in another and a little in another, when I see something get out of favor, I try to make a decent sized bet because I like to buy things that are out of favor. Those of you who've seen my other videos, I recently made an okay size bet with Boeing because I feel the same way. Now, different, that isn't the dividend account. This is specific to the dividend account. So when I saw a 15% yield in a company that I think is doing okay and isn't going out of business, that was really attractive for what the goal of this account is. And that really gives me a huge boost to getting to that goal of $4,000 a month. So next on the list, with a little bit more of a reasonable position in it, is Omega Healthcare Partners, ticker symbol OHI. I'm currently getting $871 per quarter from them. What they are is they're a REIT as well, but they actually invest specifically in home health care, not home health care, forgive me, in retirement homes where they rent out the land and the space to the people who run the facilities. I think it's a really good space to be in. I think that as people get older and we have an aging population, they're going to need retirement homes. And what they do is they're not running the retirement homes, the operators are. They find the locations and they do the mortgages and help with facilitating that. So as long as the operators are able to pay their bills, they're able to pay their dividend. It's a nice big dividend. I think it's a really good company. They've been around a while. They weathered the storm in the dot-com bubble. I think they'll weather the storm through what's going on now with the higher interest rates and lower interest rates. But I don't know. I guess we'll see, and I'm comfortable with them as a company. Next on my list is also kind of in healthcare, but a different aspect of it, which is Pfizer. I think you're all familiar with Pfizer. Their ticker symbol is PFE. What I like about Pfizer is they've been super out of favor because they kind of went up too far probably during COVID when they were doing the COVID vaccines and getting income from that. As that settled down and the income from the vaccines has come out of play, and they've had to just rely on their regular pipeline of stuff, the stock has pretty much fallen in half. So what I actually did was I rotated out of something else and moved it into Pfizer because I feel like out of favor is probably on sale. Now they recently had earnings and they crushed it. I was kind of happy not to see the stock just go straight up, because what that tells me is slow and steady. Like, I really like them as an investment. Right now, they're paying over a 6% yield. And if this quarter's earnings is any indication of future earnings, they can easily pay it. They were expected to make 51 cents a share, if I remember correctly, and they actually came in and made 81 cents a share. So talk about crushing earnings. And the stock had just kept falling and falling into those earnings, and then when those earnings came out, they were up a little bit. I mean, percentage wise, it was decent, but not what I would have expected. Now, what I really think is, if you're putting a lot of money into a company like Pfizer, you can't just buy it, because you'll push the stock price up real quick. So you have to try to do it very slowly and not move the market like that. So I love Pfizer. I'm making $588 a quarter off of it. I actually have some in the account separate, where it's the safe deposit one, because I feel like they're a great long term company. I don't really see them going out of business. Those are the companies when I look for when they're out of favor to maybe make a decent sized bet on. And then the next one I have is a monthly dividend payer. It's actually a preferred stock fund. I don't have any preferred stock, so this is my way of owning some of it. And similar to NextEra Energy Partners, but a little bit differently, I actually have a rather large bet in it, but not because I saw an opportunity or anything like that. I got a little over attracted to the monthly payouts, and since I don't have any investment in preferred stock, I felt like this was my way of getting into that sector and maybe being a little diversified. Now, it's probably a mistake to do it in only one company. And if I didn't say it, the ticker symbol is PFFA. I might have forgotten that. But maybe it's a mistake to invest in one, essentially ETF, but it's more like a mutual fund, or however you think of it, company that's investing in it, because if their advisors aren't doing a great job, it's a little much too much of all your eggs in one basket type of thing. But for whatever reason, I was comfortable with them. I get $845 a month. Between them and NextEra Energy Partners, it's really a huge percentage of the total portfolio to push that high yield return to get the dividends to help pay bills and get that $4,000 a month in my sleep. And last on the list is Starwood Properties, STWD. I think you're all familiar with them. They have a bunch of different hotel chains that you most likely have heard of. I get $528 a quarter from them, and that rounds out the entire portfolio. I really like Starwood. I think that they're in a good position. It's a REIT similar, but as I mentioned, it's the hotel industries, Starwood brand properties. Feel free to look them up. They own a bunch of different hotel chains that are quite common. Um, and I like getting that high dividend. It's close to a 10% yield, and then it gets me in the hotel space, and with a dividend payment. Now, in total, those stocks and the amounts that I have pay $48,352 a year. Don't forget that that is not guaranteed. Companies can raise dividends, which is what I hope for, but they can also lower dividends. And like the one I use, for example, with AGNC, if it's paying 15% yield, they have to make enough money to be able to pay that, which is very difficult. And I think it could be likely that they end up having to cut the dividend over time, which is why you guys need to do the research for what works for you. The total account value is a little below $520,000. So it's a big number that you have to get to be able to get the $4,000 a month to live on and help pay bills. But if you save and save, which is what I talk about all the time, what I hope from these videos is I encourage people to not buy whatever it is for 10 or 20 bucks and put it in your account and continue to save, because those $10 and $20 here and there really add up, and eventually you can save up to enough money that it helps pay bills. Now, long term, despite the examples I used, I would rather create an account portfolio that includes things like Johnson and Johnson, Pepsi, JP Morgan, Caterpillar, Procter and Gamble, or Exxon and Chevron. Companies like that might have a lower dividend yield, but I think are probably better companies than the ones I gave in the portfolio example. Now, again, I'll repeat it. The reason I'm using the ones I'm using is I'm pushing for higher dividends specific to this account because that's the goal of the account. But I think that takes on bigger risk. If you own a company like Pepsi, well, the dividend's going to be much lower, but they're pretty well spread out in a bunch of different categories, even though it's all food and beverage. But you're probably pretty good to be able to get that dividend, and there's potential for the stock to grow. I feel the same way with Caterpillar, which is a great company and a great industry. And again, it just has a low dividend payment or yield. So it's hard to drive the amount of income I'd like to drive from those types of companies unless I was fortunate enough to have, 10, $20 million to get 1, 2% yield and be making a lot of money. The other thing about dividend companies is if the economy does slow, they tend to have a little less volatility. They'd likely go down with the economy as well if the economy really slowed and their earnings weren't as good. But if they're able to pay those dividends and help pay the bills, you don't worry the same way you might with other companies where they're not paying the dividends and have the ups and downs. And I find the stock market is, 90% emotional, 10% about the numbers. I know I've talked about Starbucks in the other videos. I still think they're a great company and they pay a dividend as well. But I do worry after the earnings and the stock dropping as much as it does that their long-term path may take a lot longer. I wasn't real happy with what the CEO said. So if you're in these companies that have a tough time, um, you have to deal with the ups and downs and how they do. Anyway, I hope you have a great Saturday. I'm actually going to go volunteer some time at this place called Miracle League. Pretty cool thing. We go and we play, I'd say baseball, but it's really more like a wiffle ball that is easy to hit with kids with disabilities, both mentally and physical. It's a couple hours out playing ball, having fun, helping them, learn how to run the bases. Seems like a nice way to give the families a break, and the kids have so much fun. So we're going to go head out and do that. Don't forget, if you haven't already, hit that subscribe button, smash the like button, make some comments. Let me know some dividend stocks you guys like. There are tons out there that are great companies. And again, these are really off. A lot of them are just high yield to try to drive that dividend to bring the income in. I don't know that I think they're the best companies. I think the best companies are things like Amazon, Google, Microsoft, Tesla, who's the one I'm forgetting that I kept thinking of? Oh, and Meta. Meta is one of my favorites. So those are what I think the best companies are. These just are good for helping to pay the bills. And as I get older, I slowly would siphon out of the best ones into the ones that help pay the bills so that I can relax and live off of that stuff. So have a great day. Bye bye.